Okay, so imagine this. You buy insurance on your neighbor's house.
Not your house, their house.
You don't own it. You don't live in it. You have absolutely nothing to do with it.
But you're allowed to buy insurance that pays you millions of dollars if it burns down.
Now here's where it gets weird.
You can buy that insurance policy 10 times over.
So can your friend. So can a hedge fund in New York.
So can a bank in London.
Suddenly, there are 50 insurance policies on your neighbor's one house.
And if that house burns down, someone has to pay out 50 times what the house was actually worth.
And now replace your neighbor's house with the entire U.S. corporate debt market.
And you've just described the $600 trillion derivatives market that nearly destroyed the global economy in 2008.
And is now 4 times larger than it was back then.
Yeah, we need to talk about this.
My name is Nick, and I spend way too much time thinking about financial systems that could implode at any moment.
If you're someone who wants to understand how the economy actually works, not the sanitized version they teach in school, but the messy, terrifying reality that could wipe out your savings overnight, make sure to hit the subscribe button.
And give this video a thumbs up if this helps you out. Because here's the thing. Most people think the 2008 financial crisis was a one-time event.
A learning experience.
Something we fixed with regulations and oversight and all that good stuff. But the financial instrument that caused 2008, these things called credit default swaps, didn't go away. They got bigger. Way bigger. And right now, 3 banks control 80% of them. The market is worth more than the GDP of every country on Earth combined. And almost nobody is talking about it. So today, we're going to break down exactly what credit default swaps are. How they almost destroyed civilization 17 years ago. Why they're even more dangerous now. And what you can actually do to protect yourself. Because, spoiler alert, this affects you even if you've never heard of derivatives. Let's get into it. All right, so first things first, what is a credit default swap, or CDS for short? At its core, it's insurance on debt. That's it. If a company or government borrows money and can't pay it back, the CDS pays out to whoever holds it.
Sounds reasonable, right?
Like, if you lend your buddy $10,000 and you're worried he might not pay you back, you could buy insurance that covers you if he defaults. Here's what most people don't realize. You don't actually have to own the debt to buy the insurance. Let me say that again, because this is where the whole thing goes off the rails. You can buy insurance on debt you don't own. It's like buying fire insurance on a random stranger's house and collecting a payout when it burns down. In the insurance world, this would be illegal. It's called insurable interest, and you have to have a legitimate stake in what you're insuring. But in the derivatives world, totally legal. Totally unregulated. And totally insane. So what happened in the 2000s is that banks and hedge funds started buying credit default swaps not as insurance, but as bets. They'd bet that certain companies or mortgages would fail, and if they were right, they'd make a fortune. And because there was no limit to how many swaps you could buy on the same debt, the market exploded. By 2007, the credit default swap market was worth about $60 trillion. For context, that's more than the GDP of the entire world at the time. People were making bets on bets on bets, and nobody really knew who owed what to whom. Now, you might be thinking, okay, Nick, but didn't we learn our lesson in 2008?
Look, here's what actually happened.
The crisis started with subprime mortgages. Basically, banks were giving home loans to people who couldn't afford them.
then bundling those loans into securities and selling them to investors. Wall Street loved these things because they were rated AAA, which supposedly meant they were super safe.
But here's the kicker. Insurance companies like AIG were selling credit default swaps on these mortgage securities. So investors would buy the sketchy mortgages, then buy insurance from AIG in case they went bad. AIG was raking in premiums, and as long as housing prices kept going up, everything was fine.
Then housing prices stopped going up.
When the mortgages started defaulting, AIG suddenly owed billions of dollars in payouts.
And here's the thing, AIG didn't have the money. They'd sold way more insurance than they could ever cover, assuming they'd never actually have to pay out.
And because the credit default swap market was so interconnected, AIG's collapse threatened to take down every major bank on the planet.
If AIG went under, the banks that bought swaps from them would lose billions, which would cause them to collapse, which would trigger more defaults, which would cause more payouts, and the whole system would spiral into oblivion.
So the US government stepped in with a $182 billion bailout. Not to save AIG, really. To save the banks that would have lost everything if AIG failed.
This is where it gets really interesting. The crisis wasn't caused by mortgages. The mortgages were just the trigger. The real problem was that the entire financial system had become one giant interconnected casino where everybody was betting on everybody else's bets.
And when one domino fell, it threatened to take down the whole stack. Okay, so after 2008, you'd think we'd ban credit default swaps, right? Or at least heavily regulate them? No?
The Dodd-Frank Act in 2010 added some transparency requirements and forced some swaps to go through clearinghouses, but the market itself kept growing.
As of 2024, the notional value of the derivatives market, which includes credit default swaps, is estimated at over $600 trillion.
That's not a typo. $600 trillion. For context, global GDP is around $100 trillion. Now, to be fair, notional value doesn't mean that $600 trillion is actually at risk. Notional value is the total amount of underlying assets being referenced, not the amount that would actually be paid out. But even if the actual exposure is a fraction of that, say 5%, that's still $30 trillion, which is roughly the size of the entire US economy. And here's the scary part. According to the Office of the Comptroller of the Currency, just 3 banks, JP Morgan Chase, Goldman Sachs, and Citigroup, hold about 80% of all derivatives in the US banking system. So if one of these banks miscalculates, or if there's another systemic shock like 2008, we're not talking about one company failing.
We're talking about a collapse that could freeze global credit markets, trigger bank runs, and potentially send the world into a depression.
Now, you might be thinking, okay, Nick, but didn't we fix the problems from 2008?
Aren't banks required to hold more capital now? Isn't there more oversight? Yes and no.
Banks do have to hold more capital under Basel III regulations, and there is more transparency in the derivatives market. But here's what most people don't realize. The system is way more fragile than it was before. First, interest rates. From 2008 to 2021, interest rates were basically zero.
That meant borrowing was cheap and defaults were rare.
But since 2022, the Fed has jacked up rates to fight inflation. And suddenly, a lot of companies that could barely afford their debt at 2% interest are drowning at 7%.
According to Moody's, corporate defaults in 2023 hit the highest level since 2009. And every time a company defaults, someone holding a credit default swap gets a payout. If enough companies default at once, the banks that sold those swaps could be on the hook for billions.
Second, the too big to fail problem has gotten worse, not better.
Those three banks I mentioned, JP Morgan, Goldman, and Citi, are now bigger than they were in 2008. If one of them goes down, the government would have no choice but to bail them out again, because the alternative is global economic collapse.
And third, and this is the part that keeps me up at night, we have no idea how interconnected this stuff is. The credit default swap market is opaque. Even with the transparency requirements from Dodd-Frank, a huge chunk of the market is still traded over the counter, meaning it's private contracts between two parties. Regulators can't see the full picture.
So we're in a situation where the market is bigger, interest rates are higher, corporate debt is shakier, and the banks are more concentrated than ever. It's like we took the 2008 time bomb, made it 4 times larger, and then just hoped it wouldn't go off.
All right, so that's the bad news. The good news is that you're not powerless here.
You can't stop the derivatives market from imploding. That's above our pay grade. But you can position yourself to survive it if it happens.
Here's what I'd recommend. 1. Diversify your bank accounts.
If you have more than $250,000 in one bank, you're not fully covered by FDIC insurance.
Spread your money across multiple banks so that even if one fails, you're protected. 2. Hold some assets outside the banking system.
This is controversial, but hear me out. In a systemic banking crisis, you want to own things that don't depend on the financial system functioning.
That could be physical gold, Bitcoin, real estate, or even just supplies and tools.
I'm not saying go full prepper, but having some of your wealth in tangible assets is smart.
Thanks for watching. Stay smart, stay safe, and I'll see you in the next one.